But what happened next is, really the next day, is Robinhood and some other brokers, they halted trading of certain securities. I believe it was GME and 12 or other 13 securities in when it came to Robinhood. To a certain extent, you can argue a red herring when it came to the blocking of trading of other securities, as GameStop has been very much the problem of some of the hedge funds and the elite investment community when it comes to kind of their pockets and their wealth. But it's important to know, and when it comes to assessing whether this is market manipulation or not, it's important to know that Robinhood blocked the buying of GME, for example. And let's just stick to GME. So they still permitted people within their accounts and on their platform to sell the stock, whatever, but they didn't allow them to purchase the stock anymore. And this is quite shady, and I'm going to explain it from the perspective of an order book. What that is, and essentially how they pinned the order book and how that can be perceived. I mean, how to a certain extent that is genuine market manipulation, aside from the reasons for which Robinhood halted the trading, which I'll also get to. It's very important to cover that. But anyways, I'm going to share my screen again. Yeah, so essentially the order book, as we see on the right here, is the order flow, all of the bids and all of the asks. So all of the purchases, all of the orders to purchase a stock and all of the orders to sell a stock, right, respectively. And so what happens here is that Robinhood's business model is not they don't make money from the people on their platform trading freely as they wish. When Robinhood mentions that they want to protect their customers, they're not talking about the people of the accounts necessarily. What Robinhood does and what allows them to commit to commission-free trading, which again, that there is no thing such as a free lunch. The explanation here is that what Robinhood does is that they collect the order flow, essentially, of all of the orders from the people on the platform with their accounts, whatever that may be. And recently, that was a lot of buy GME orders. Right, and so what they do is they bundle them up and they give them to Citadel, which is their customer. The clients on Robinhood's platform are their product, right? Their orders are their specific product, and so they bundle all of these orders together. They sell it to Citadel, and via the kind of economies of scale, they essentially enable Citadel to execute all of these orders at once. As opposed to Robinhood essentially filing off the orders one by one at a certain time, at a certain period of the day. They sell these orders to Citadel, and Citadel can actually front run these orders anyways. I mean, they know the trading volume, they have the data on people's orders, right? They know what might be able to move the markets, what are the specific bid and asks of whatever. So it's insider trading again, but just with a bit of glam. It's again, platforms like Robinhood are a bit more new, but I mean, they have themselves said that they're pioneering the space they're in. But nevertheless, anyways, what Robinhood does is they collect the orders. This order flow goes to Citadel. They execute, right? And what we can observe from here is on the order book, as we see on the right of my screen. I'm actually going to zoom in. Specifically to the order book, is we see the purchases to orders to purchase, i.e. the bids on the left and their density, and the orders to sell, which is the asks for the on the right. And so as you can see on the bottom on the x-axis, there is the price, and on the y-axis you have the trading volume, right? Now this isn't necessarily if this is just an audio version that you're listening to, this will make sense just via whatever I'm saying. Essentially, what you see in a normal order book is that the more orders there are to buy or sell, the more money it's going to take to move the price, right? Because at each price level, you're going to need to either purchase, in one way or another, honor these contracts, whether that's to sell or to buy, clear these contracts, and move on to the next price level, right? If 100 people want to buy some stock at $100, you're going to need 100 times 100, 10,000, let's say US dollars to clear that level, if I got the math correctly, actually. You're going to need that amount of money to clear that level, and essentially that's going to move the price, right? So when you have a lot of, for example, and this is what caused GameStop's price to initially spike a lot, because people just wanted to buy. People wanted to buy, they wanted to purchase call options, buy, buy, buy. That's all they did. And because the hedge funds had already shorted so much of the stock, there was a lot of buy orders or bids, and there was very little sell orders or asks. And so it was easy for the price to move up so much because there wasn't many people selling. There was an insane amount of people buying. And so with the trading hold, what Robinhood did essentially is close the tap on the bids, close the tap on the buy orders, because a lot of them came from Robinhood, right? That's where the Wall Street Bets people, a lot of them use Robinhood as a brokerage. And so what Robinhood did with their trading hold is essentially limit the buy orders. And so when you look at the order book, there just wasn't many. There weren't any bids. There weren't many people trying to. There weren't many orders to buy because they couldn't. Right? They couldn't. They had to go to the New York Stock or any other broker, or any other platform wherein you can trade aside from Robinhood. But a lot of people have their money and it's locked up and whatever. But the sell side didn't change. So all of a sudden, on the buy side, you've got the order book completely drying up, and it doesn't take much money to move the price down. Because again, if you have even just 1 or 2 sell orders, right? Only 1 or 2 people want to sell 1 or 2 stocks, or specific whatever amounts of money. If there is no one willing to buy at 100, it's going to go down to 99. If there's no one if there's no one willing to, if there's no one able to technically buy at 99, it's going to keep going down. At 98, the same, up until 50, where some random other guy, or not random, but some guy on another platform, is now willing to buy GameStop because whatever. And that's when the price fall stops. And that's why when Robinhood halted their trading, in essence, the purchase of these stocks and some others, not the selling, that's why the price of GameStop, for example, just plummeted 50%. And that's why, essentially, you can make the argument that what they did with that trading hold is market manipulation. Now, whether their intent was to do that, that's a whole different thing, because Robinhood has their own reasons for specifically protecting their financial liabilities, as I'm going to go into in a second. But the idea here is that Robinhood closed the tap on the buy orders. There was no buy orders, or very little, and there was little money needed to move the price down, and essentially recover the losses of the hedge funds, whilst screwing over some of the Redditors or people on the other side of the transaction. Okay, so that's essentially that from the order book. I will now play Robinhood CEO's essentially